Hey guys, welcome back. This is James from the Pragmatic Investor, and obviously tons of stuff happening in the market in the last few weeks. So I thought it would be a great chance to make another video and really cover things in depth and just a nice change of pace from the articles. You get to see me and hear my lovely voice. So let's jump straight into it. Okay, so we prepared some slides here to really kind of organize ourselves and cover this topic well. I've titled it The Slow Path to No Tariffs, Liquidity, and New All-Time Highs. It's time to go long. Pretty unequivocal there in my stance. Obviously, we're going to dive into the little details, but, ultimately, definitely looking like some interesting times and, kind of going to take a little contrarian view here. So, first of all, why have markets sold off? Well, obvious reason is everything to do with tariffs. Just wanted to point out this chart here. Here, what we have is the what they call the Buffett indicator. Looks at the valuation of stocks, in terms of what does it? It measures the GDP compared to the total market cap, right, of stocks. And as we can see, we were getting pretty high up. So, while it's very easy, I think the market tends to obviously see price declines, and obviously it wants to give it a narrative. I mean, in this situation, of course, it's had a lot to do, but ultimately, I think we were getting pretty high in terms of valuations. Obviously, technicals getting overheated. But so I just wanted to point that out that there are a lot of moving pieces here. We can never say stuff for certain, but in this case, obviously tariffs big deal here, and obviously it's what we're going to be talking about. Okay. Now, this is the interesting part here, right? We've got to start to assess the damage that the tariffs have done. Okay, so Trump came out on Liberation Day, 10% across the board. And then, of course, those reciprocal tariffs, which God knows how he calculated them. Um, Pretty crazy stuff. Obviously, even the market wasn't expecting such a kind of sweeping round of tariffs. But nonetheless, it's pretty clear that what he's doing here is kind of obviously putting tariffs on everyone to really kind of bring them to the table and kind of resolve this issue quickly, right? Even in the wording he's used, obviously, even though he's doubled down on tariffs and he's maintained them, he has left the door open for communication. And in fact, I believe the Secretary Department. The US Secretary said that they'd had about 70 countries come and negotiate. So, that is some encouraging news. Ultimately, I'm hoping that this is the way things are going to go. I believe, this is definitely a possibility. So basically, in terms of assessing the tariff damage, we have three types of countries, right? We've got those that have fallen in line. Examples, Vietnam, Taiwan, Japan, starting to kind of fall in line. Smaller countries, smaller trade partners, obviously, then we have some kind of more undecided. Mexico has generally played ball in the past, India, Australia, not happy about the tariffs, but looking like they could be okay. And of course, the holdouts, right? Of course, the holdouts are the larger trading partners, China, Europe, Canada. China mainly is being the is going to be the big holdout here and the one that's really putting pressure on the US right now. Uh, Whereas Europe and Canada, I can see eventually folding, but ultimately, I'm hoping that we're going to see kind of these tariff talks kind of take a step back. We did see that kind of fake or what was fake news about the White House taking down the tariffs. It was then taken back by the White House. We saw markets rally strongly on that news. And then actually, once that news was gone, they did sell off a bit, but we did end the day actually green and, pretty encouraging signs. Okay, probably just a bear market bounce for now, but we'll see how things develop. Now, the big problem here is China and the risk that this trade war is going to develop into a tariff war. And that is pretty much something, I think that's the next level of what the markets could be getting ready to price in. Very important news here. The Chinese yuan has broken above 7.2. That hadn't really happened in a long time. This is kind of like an unofficial band that they have where they try and keep that exchange similar to that exchange relative to the US dollar. That is now broken. In other words, we're talking devaluation here, okay? Competitive devaluations, not unlike what we saw back in the 1930s. Okay, similarly, obviously now we're also seeing China accelerating its sales of US treasuries. Obviously, it's been accelerating this over the last few years, and especially now it's begun to really take us to the next level. In fact, it's quite interesting if we look at the US 10-year yields, which, as we've explained before, were the objective of the administration, I believe. they're trying to get the 10-year yield down. The 10-year yield has bounced back now. It's pretty much back above that pre-Liberation Day tariff announcement. Now, what's happened here? A couple of things. Obviously, China not playing ball, imposing those retaliatory tariffs, and potentially, although it's a bit speculative here, but potentially some degree of China unloading those US treasuries on the market. Okay, now the other interesting outcome from this is, of course, that inflation is going to be much more under control now. I've talked about this a lot before, but tariffs aren't actually inflationary, in my opinion. I view them as a sale tax. I view them as something that is basically taking growth, potential growth out of the market, and to that extent, they're actually deflationary, in my opinion. Okay, so we have a lot of deflationary things coming into play now. Obviously, I've pointed out this chart before, the new tenant index really pointing us down, suggesting that the rent component of CPI is really going to start falling. Very interesting also, oil completely plummeted, of course, alongside markets. Now, this does have to do with, the flow of markets and the tariff stuff, but I think this is also very deliberate. I think, we've seen the Saudis begin to expand oil production, and I think this has actually been done pretty much. This was something that Trump and his administration kind of wanted as well. So it's definitely very intentional in my opinion, and it's going to have a big effect moving forward. Okay, I don't see how CPI is going to surprise to the upside, especially if, like I predict, we can get some relief on those tariff talks. Okay. Now, in terms of the economy, I did say, we would be looking at employment numbers. The non-farm payrolls came in a lot better than expected. Unemployment still pretty subdued. The only thing that does worry me a little bit is we have seen those credit spreads really begin to kind of peak up in the last few weeks. So showing that kind of obviously showing that market turmoil, but nonetheless, the fundamentals still remain pretty decent in terms. Again, we're talking about employment, inflation coming down, and the other stuff we mentioned before, manufacturing still looking okay. So again, I think there's a lot of negativity priced in, and the economy could hold on at least for the next few months, while we also get, a much higher likelihood that the Fed begins to cut. Okay, we now have 27% chance of a cut for the next meeting in May, and 70% for the meeting in June, I believe that is. So obviously pretty good in that sense. We know that the Federal Reserve has already started to wind down its QT. And this is something that I mentioned before. It's very important because of, what we talked about in our last report, right? Now, this is something that I discussed with Michael Howard at length. Check out his work. It's really good. He does a lot of work around liquidity, and this idea that basically, to the extent that we live in a debt finance world, the problem with debt isn't the amount of debt, it's the amount of debt kind of relative to your balance sheet capacity, or what you call liquidity, right? It's all about rolling over debt, and the amount of debt you can roll over depends on how much you have in terms of assets, right? I mean, it's kind of like when you get a mortgage, right? The size of the mortgage is going to kind of depend on your income and also on the assets that you have, right? Your balance sheet capacity, as he calls it. So to that extent, I think that, and again, veering into the conspiracy here, but I do think that there might have been some kind of understanding here, coordination going on with the administration and the Federal Reserve, providing cover basically by, really kind of, pushing this narrative now, helping obviously take the market down, take the 10-year down. We know that they do want to take the 10-year down, obviously probably don't want to crash the market, but they don't care about that so much now. But I think this is providing the perfect cover for the Federal Reserve, especially now with inflation probably so subdued again, rents, oil really coming down, and ultimately, I believe tariffs not having such an inflationary effect. So this provides the perfect cover now for the Federal Reserve to really begin to ease without having to worry so much about inflation and really handle that big problem, which is actually the refinancing of debt. Okay, I forgot to put the charts up here, but that is going to be a big worry also, over the next few months. Going into the third quarter, even, I think that's where Michael kind of draws a deadline there in terms of actually refinancing a lot of the debt that the US government has and also the private economy. So that's why it's so important that, the Fed pretty much begins to ease at this point. Okay, and what is next in terms of trading this? How do we play this? Obviously, I think that we can be quite, personally, I'm quite bullish. Obviously, valuations have come down a lot. We're testing important levels of support, so a good place to buy, near 200-week moving average, stuff like that. And like I said, I'm optimistic, at least to the extent, to the more immediate extent. I think that, we could see some escalation. I think China really is where we have to watch out, but I do think that, the tariff talks slowly, the ultimate objective of the administration isn't to crash the economy or to crash the stock market. And, eventually we are going to get some walk back. We're going to get countries coming to the negotiating table. And I think we are going to see some kind of deal. And, that is going to help a lot together with that increased liquidity and, with the lower inflation and economy holding up as it is right now. I think we have a good bullish setup. Okay. So to that extent, first of all, I want to talk about, kind of how to trade this, looking at the chart, that kind of stuff. And then we're going to talk about the best stock to buy on the dip right now. And also another couple of stocks that are actually going to benefit a lot from this new lower oil prices. Okay, so let's dive right in.